Hi, welcome to today's webinar, Legacies Across the Pacific, Smart Strategies for US Inheritances with Australian Beneficiaries. I'm Ashley Murphy, the founder and principal of Arete Wealth Strategists, a registered investment advisory firm focused on serving the needs of Australians in America and Americans in Australia. The only, I'm pleased to say, mass affluent wealth manager that is certified and approved and registered in both Australia and the US. So we're able to provide personal advice in both countries by way of the partnership that I have with the firm in Sydney, IMFG, that is an Australian financial services license holder. Okay, moving on. So I did want to just note the disclosures here. Today does not represent personal advice. Has not been taken into consideration. Your specific circumstances have not been taken into consideration. You should not act based on this. You should engage with an appropriately qualified financial professional for your circumstances. Having said that, I should mention on our YouTube channel, as of, as of a month ago, you'll find the One Big Beautiful Bill summary. So I did that. I was one of the first to get something up about that. About 2 weeks after President Trump announced that new legislation, so you can find that there. If you're interested more broadly in these topics, then I would encourage you to become a subscriber to my YouTube channel. A little bit about me. So as I say every month when I do these webinars, I was really born into this situation. It was my calling to be a cross-border financial advisor. Why? I was born in the UK, raised in Australia, spent 20 years in the US, and at the beginning of this year, I moved back to Australia with my family. However, preceding that move, I also spent 2.5 years here during COVID before moving back to the US for 18 months and then coming back here earlier this year. I have been running Arete Wealth Strategists now for 12 years, registered in California, August 6, 2013. And I've been a financial advisor since 2010. Prior to, I won I was a runner-up student of the year at UC Berkeley Extension in financial planning, and I won all of the scholarships in the East Bay and San Francisco when coming through the financial planning program there. I'm also the co-founder of the Global Financial Planning Institute, where we train fiduciary financial advisors who work with clients whose financial lives cross borders in how to work with such clients appropriately, given the lack of training that exists out there. So Arete Wealth Strategists, here are 3 different types of clients that we work with and the results that you see. But I'm excited to get to today's content. And the reason why is that this has been years and years in the making. This is really the culmination of so much professional experience and knowledge to be able to present this to you. The first thing I want to do before I talk about the summary of what we'll be covering today is to say what I won't be covering. So the focus of today's presentation is for those that are US individuals, essentially, people that have US estates with Australian, they use this beautiful term, non-resident alien, NRA beneficiaries. So if that's your situation, today's presentation is entirely geared towards your situation. But as you can see, there are other permutations that we will not be addressing and that I have addressed in previous webinars as recently as a year ago and again or before that in 2023 and 2022. So today is about the Australian beneficiary. And what am I going to be talking about? I'm going to introduce the concept of transfer taxes. I believe that providing a broad education in this field is valuable to you being an empowered consumer. That way, if this situation happens to befall you, or you are indeed the estate, you're the owner of your own US estate, then you're able to plan better and forewarn your beneficiaries as to what to expect and structure things more efficiently. There's no prizes for leaving a tip to the IRS or the ATO. You're smart to structure your estate in a manner such that your assets go to who you want them to go to, when you want them to go to, in an expeditious and cost-efficient manner. Okay, so first, transfer taxes. Next, differences between the US and Australia and how they deal with estate taxes. Estate taxes are a subset of transfer taxes. I need then to define what the situs of an asset is. You'll always see it in italics. Situs is a Latin word, and it refers to the site or where an asset deemed to be located. Not very complicated when dealing with real property like real estate. Not many people have many questions about where real estate's located, what country it's located, but things like money sitting in a bank account or treasury bonds or life insurance, where do they exist? They exist in the ether somewhere, or how do the international rules work for locating where these assets are located, the situs of the asset? Next, we move on to tax treatment by asset type, then talk briefly about the US-Australia estate tax treaty. I'll cover a summary, an up-to-date summary of what states in the US have their own estate and or inheritance tax. Now, that's a tricky distinction right there. The lay individual listening to this might say, well, gosh, that all sounds the same, estate or inheritance tax. It's not. The estate tax hits the estate. It's charged against the deceased, essentially. So whatever they leave behind, the estate tax hits them, whereas the inheritance tax hits the beneficiary. So in the example of someone who had 5 children, for instance, there may be no inheritance tax for an estate of the same size compared with someone who only had 1 child, because the amount of the inheritance obviously is going to be 5 times greater for the only child compared with that person that's part of a larger family. Next, moving on to strategic estate structuring. There's not a great amount to do, is the bottom line there. For mass affluent folks, if you've got an estate tax problem, which means that you're worth a bit of money if that is your issue, it's 13.99 million US dollars today, rising to 15 million next year. So, and there's spousal portability too. So you actually are looking at a net worth of double those amounts, so $30 million next year. So it's a very much an affluent, a high net worth issue to be dealing with estate taxes, but there's still a lot of administrative tips, and there are some other things that can easily be handled as well. I had a very complicated example that I was going to give, but honestly, even I have a limit for how much time I can spend preparing for these webinars, because I enjoy being an educator, but there's to come up with such a complicated case study. And I did in fact have a client like this, where they have a US estate and they have children in the UK, the US, and Australia. To use that as a case study would be a fantastic example, but a little too complicated for here. So issues with non-resident beneficiaries of US trusts, just briefly touch on that, and actually quite a bit of detail here on stories from the trenches. I think this is what most people are going to find relevant and actionable from today's presentation. I welcome questions throughout. I encourage you to use the chat feature. I would not suggest using the Q&A feature in Zoom. The reason why is because when I'm hosting, I can't actually see the questions that come up through the Q&A feature, but I can easily interact with the Q&A. So let's get into it. I do have to say I've got an hour. I need to be preparing for a client meeting at that time. So let's have at it. We may need to speed things up simply because there's so many slides today. Thankfully, it is being recorded. So within 24 hours, my client service associate, Nicole Molson, wonderful lady based in Denver, Colorado, she will upload this to YouTube and then notify everyone that registers, which is what we do every month. But regardless of me saying that every month for the past 7 years, without fail, every month someone asks me if they can receive a copy if they're not registered, or if they are registered. Okay, so what are transfer taxes? Transfer taxes are exactly that. It's a literal thing. If you transfer an asset from one person to another, there's a tax involved in that very often. And so a very common one we're familiar with here in Australia is stamp duty. That's transfer of real estate from one person to another. Not a thing in the US. There are certainly transaction costs, but there's no specific stamp duty such as they have in Australia. There's estate taxes that we have to deal with in the US. There's gift taxes, again, in the US. And in the US, they define GST quite differently. It's generation skipping tax, not goods and services tax. It's generally based on the value of the property being transferred, and it may be charged by federal, state, or local authorities. So the domain of what we're talking about here is transfer taxes. And I'd put it to you that Australia is pretty clever when it comes to how it deals with transfer taxes, insofar as they got rid of the estate tax and gift tax many decades ago. Now, that sounds great, and people who don't know what they're talking about get excited to hear that there's no estate tax in Australia, but they fail to appreciate that the ATO gets their slice no matter what. And the reason why is, outside of a couple of specific exemptions to do with the primary residence and superannuation accounts, everything is settled to cash ultimately. So if you inherit a stock account or an investment property, your basis, in the case of assuming they're not pre-GST assets, your basis is the basis that the deceased purchased the asset for. So eventually, someday, when someone goes to sell that asset, the ATO is going to have their hand in your pocket and they're going to recover the full capital gain amount. So it's a clever way to do it. If I had to bet, however, given the recent attention that we've seen, several articles in The Economist have noted this. They're talking about globally the number of high net worth and ultra high net worth individuals that are being quote unquote created, half of which, I think it was actually slightly less than half, it's like 35 to 40%, are actually coming from inheritances. So mega rich people that then just pass that down. We've seen a lot of wealth created in the last 20 years in Australia. Wouldn't surprise me if the greater political attention came to bear on the children of Australia's billionaires as a result of changing wealth dynamics. But anyway, that's a commentary that we can leave for another time. So the main difference we see here is the US has a specific federal estate tax. If you've got an estate above 13.99 million as an individual in 2025, you're going to get hit with a 40% estate tax on the amount above that. Now, the US runs a rules-based system. Australia runs a principles-based system. What does that mean? That means in the US, if there isn't a rule that specifically deals with your situation, you're good, you're in the clear. Not so in Australia. They write rules very broadly to encompass whole strategies and situations. They say, if this is what you're dealing with and this is what you're trying to do, it's not allowed. We don't care if you do it through this type of account or that type of account, or move it here or move it there. It ain't allowed. And so that's a principles-based system. It's a lot more rigorous and leaves less, to use a euphemism, it leaves a lot less for the way of wealth advisors to be able to come up with better outcomes for their clients. Some might say that's a fairer system. Fair enough. But in any case, in the US, there's a lot that can be done. So if one's estate is in excess of the estate tax limits, there's a ton of strategies for how to deal with that. In fact, a good friend of mine, a good professional friend of mine who recently retired, Mel Warshaw, a very well-regarded high net worth international tax and estate attorney, his quote, which will forever remain with me, is that paying the US estate tax is essentially optional, and it's a function of whether you've done your planning or not. Be that as it may, let's continue here. Australian beneficiaries will also need to be, this is kind of unrelated, I don't know how that bullet point got quite there, but they do need to be mindful of US state level inheritance tax in specific and estate taxes in specific states, which I'll mention in a moment. Okay, so the Australian estate tax system, in summary, you can see it right here. So there's no estate tax specifically. There's also no step up in cost basis for when received from a domestic deceased. This is a very interesting concept, and I'll draw your attention to this third bullet point, this deceased estate trust. So essentially when someone dies, their assets can go back into their own estate, and that estate is treated as a trust. And that has important implications for the opposite scenario of what we're here talking about today. And that is, we're talking about Australian beneficiaries of US estates. Well, how does it work with American beneficiaries of Australian estates? If you're a non-tax resident of Australia, i.e. you're in the US, mum or dad dies, and you inherit a bunch of Australian property, it could be bad news if you can't get back to Australia and become an Australian tax resident. But if the estate itself becomes the beneficiary, then it gives you some time for you to change your tax residency and change your facts and circumstances, which means getting your backside on a plane, staying in Australia long enough, and making sure your facts and circumstances support your claim for Australian tax residency. We're not going to get into that. That is an incredibly complicated topic, but I'm fond of saying the planning outcomes are optimal when the facts support the circumstance you're trying to justify, as opposed to doing it ex post facto, which gets very tricky when you're trying to make an argument based on things you've already done. Okay, next, the ATO is in charge of figuring out what's due on Australian estates and no reporting or tax for recipients. On the US side, oh, excuse me. So the Australian tax rate depends on the nature of the asset. It's going to vary a little bit. You heard me mention the primary residence, the superannuation exemption, and the stock portfolio. So they're all treated a little bit differently. So when I'm at these events and they say, "Oh, how does estate tax work in Australia?" I'd say, "Okay, whoa, we got to slow down because there isn't an estate tax, and it actually really depends by the composition of the assets that an individual has." The timing of the transfer, the reason that matters, is it in the trust or is it not? And the tax residence of a beneficiary. Um, so that's what I was talking about just a moment ago. Might someone have the ability to become an Australian tax resident before inheriting the specific assets? So what about the US estate tax system? How does that work? As I've mentioned a few times here, there is a federal estate tax. There's also a state estate and inheritance tax on various states, and there's about 13 of them. There's an exemption threshold. If you're below that, you don't need to worry about it unless there's a lower state limit, which there is in my old home state of Minnesota. Kicks in at 3 million, 13% at 3 million. There is a step up in basis applied to capital gain assets. That's quite different from Australia. And there is this concept of portability with the estate tax exemption between spouses. Okay, key comparisons. If we were to compare how the system here works, in Australia, we don't, this is summarizing everything I just said, so it could be useful for folks if you want to come back to YouTube later to see what this summary looks like. Situs of an asset. Next, we need to define what a situs means. So how does the type and situs of an asset affect its taxation? Well, this is very important. So the situs, as I alluded to in the introduction, refers to where an asset is located. And I use an example here. I say, where is cash located? If you have cash sitting in your online bank, your ING bank account, well, where is that? It sure is not at the local branch because there are no local branches. Is it sitting at ING Australia, wherever that is, in Sydney or Melbourne? Or is it sitting in Amsterdam where ING is headquartered? Well, hard to say, really. We don't know where it is. But interestingly, it's not considered cash in a bank is not considered to be sitused in the country in which it's located. It's considered non-US situs. So why does this concept of situs come up? Because it determines there's a very important interplay with how the US-Australia estate tax treaty works with US real property versus US situs assets versus non-US situs assets. Non-US situs assets don't get counted at all. I'll say that again. For the estate of a US individual, the non-US situs assets are not included in their estate calculation for non-resident beneficiaries, meaning Australians who have no US legal ties. They are to receive things that are non-US situs. It does not count for estate tax purposes. Why is that? I couldn't say. It doesn't make much sense to me at all, but that's how it is. So determining the site is very easy with physical property, as I was saying tongue-in-cheek earlier. If you own a commercial property or a rental or something in a certain country, there's no question where that's located. But with things like intangibles, if you've got a copyright, a patent, you own a musical score, if you have stocks, life insurance, where are they actually located? Well, here is, yet again, here is one of these summary sheets that you can come to and take a look. So what is US situs? Stock of US companies. So if you've got your Google stock, your Nvidia, whatever, that's US situs. Now, if it's not a US situs company, if it's, let's say, Siemens stock or BMW stock or Novartis or something like this, that's not going to be considered US situs because the company is not registered in the US. It's the registration of the company. Real estate, obviously, that's US situs. Tangible personal property. If dad left you behind his Ferrari, like thinking Ferris Bueller's Day Off, left you behind the Ferrari, well, clearly that's tangible personal property. It has a physical location in a specific country. Private debt issued by corporate, that's an interesting one, which we'll come back to because look at that. If it's a publicly traded bond, magically it's not US size. So it makes no sense to me how that works, but these are the rules. Money market funds or cash at a brokerage firm, US situs. But what did we see about cash and demand deposits held in checking or savings account? Not US situs. Business investment assets used for US business and or held at a bank or broker is US situs. Annuities, weirdly, are US situs, whereas life insurance is not. And qualified retirement plans are US situs. So what's not US situs? US listed American depository receipts. So that's to say, if you held your shares in Rio Tinto, that's not a great example. Let's use an Australian company. Let's say you held your shares in Rolls-Royce on the US stock exchange through what's called an ADR, an American Depository Receipt. That's not US situs. Again, why? Because the company registration is not in the US. It may appear in a US listing, but the business itself is registered somewhere else. Cash, as you heard me say, but interestingly, cash is if you held bank notes, for instance, like actual money that you could count in your hand in a safe deposit box, that's tangible personal property. So that's US situs. Stock of foreign companies, that's kind of the same thing as the ADRs there. Publicly traded bonds, blows my mind how a publicly traded bond could not be considered US situs. If I had to guess, it's probably a freebie that the government has allowed themselves. So their assets are not subject to estate taxes, but private debt is. Don't know why, but that's how it is. The death benefit of a US life insurance policy. Now, this requires very specific language. The death benefit amount. In the US, you have these things called permanent life policies, some of which contain a cash value. So there's an investment component within the life insurance policy. That investment component is US situs. The death benefit is not US situs. So the amount that is truly an insurance payout is considered not US situs. And same with offshore mutual funds. They're not US situs assets. So tax treatment by asset class. Let's go through this, shall we? So real estate, obviously it's US situs. If you have a non-resident alien beneficiary, i.e. Not an Australian, we're not going to say Australian because Australia has an estate tax treaty with the US, so the normal rules do not apply. But if someone is trying to be too clever by half with you and you're at a networking function in San Francisco and New York, and they'd say, no, this is not true. Non-resident aliens are subject to a $60,000 estate tax exemption. Hey, that's correct. That is the correct rule unless you have an estate tax treaty. And so because we're focused specifically on Australians here, that does not necessarily apply. There's a formula, and we'll get to the formula because it's a little bit complicated. And I'm glad I introduced the topic of situs because it's a function of what's US situs and what's not US situs. So ongoing taxation depends on the type of quote unquote income source we're talking about. Is it rental income or is it the capital from the sale? So rental income is US and Australian taxable. If you're talking about an Australian beneficiary who keeps the rental property, well, that's US sourced income. So the US is going to have first bite of the cherry. You're going to have to file a 1040 NR, that's a non-resident tax return for the US. And then really consider, is this an asset that, all things considered, is this something I should continue to hold? It's actually, the answer oftentimes is yes, much more so in reverse, meaning, I said that ambiguously. Let me explain. It's better for an Australian to own an American property than it is for an Aussie in America to own an Australian property. And I see it all the time. All the time do I see Australians that continue to own Australian real estate, and yet it is one of the worst asset classes to own. By the way, I'm one of the only voices out there saying how bad an asset class it is, given the incentives that exist for real estate developers and mortgage people to encourage buying Australian real estate. But let me just say, you don't get a capital gain exemption. You get taxed as a non-resident. So you're at 30% on the first dollar of income. You lose your main residence exemption. The 6-year window that was over in 2019. It's very rare that it makes any financial sense to hold on to US real estate. And another bias that I see is folks say, oh, no, I'll just wait until I get back to Australia and then I'll sell it because I'll be a resident at that time. Wrong. It doesn't matter. The time that you were out of the country is partitioned. So they'll say, when did you cease being an Australian tax resident? When did you become an Australian tax resident again? Great. Let's get a value of the property from the date you left to the date you returned, and you're going to pay non-resident rates, which means no CGT discount for that entire time. So I say it again. It is just a shocking asset to own Australian real estate if you're a non-resident, unless you see yourself moving back into that property at some point in the future. But even then, that period of non-resident gain will stay with you forever and a day. Next, shares and investments. They are, assuming you're talking about a US stock portfolio, it is a US situs asset. It is subject to US estate taxes. How are dividends taxed? Taxable in both countries, with US withholding at 15% for non-resident aliens. That's what NRAs is. It's not a reference to the National Rifle Association. It's an abbreviation of non-resident aliens. So there may be possible credits there. If you were to sell your asset, it's actually interesting how this works. So the cost basis is stepped up on the Australian side, which please note what I'm saying here. If the estate was an Australian tax resident and you receive a stock, no step up in basis. If, however, the deceased estate was a non-Australian tax resident, then there is a step up in basis to the fair market value on the date of death. So grandma here dies owning a portfolio of stocks she bought back in the 90s when Microsoft was down in single digits in her taxable brokerage account. The taxable basis of the portfolio is low, i.e. meaning there is significant gain, and thus she had sold the portfolio prior to her passing. There would have been significant dollars that the IRS would have been only too happy to relieve her of. However, as there's a step up in basis in death in the US, there's also a step in basis in the Australian side. The portfolio's taxable basis is equal to the fair market value on her date of death. Step up in basis also applies on the Australian side. So no one's happy about grandma passing away, but this has resulted in a great tax outcome given the step up in basis. Next, US retirement accounts. Now, these are really tricky, and I mean really tricky, for non-resident alien beneficiaries. And the reason they're so tricky is because they're practically difficult, meaning to actually roll it over and to begin distributing it when you're not in the US system, boy, if you're doing this without professional help, you deserve a medal for your patience and persistence, because it is hard. It is very hard. So it's a US situs asset. So someone's passed away, they've got a 401k, a 403b, an IRA, whatever it is. Someone in Australia has inherited this asset. They are not a US tax resident. They don't have a social security number. How does it work? Well, here's the thing. I know I don't know this, and I like to be upfront when I don't know something for sure. But what you can do prior to death, and we do this all the time, when someone's moving back from the US, subject to the tax treaty, Article 18.1 in the US Australia Double Income Tax Treaty deals with retirement distributions. But things are different in this scenario. This was a retirement account for the deceased, but for the beneficiary, you did not come into this money by way of money set aside from income related to labor with the purpose of retirement. The way you came into it was fundamentally different. You inherited this asset. So, does the tax treaty provide a step up there? I don't know, and I'm not optimistic. That remains a known unknown. But in any case, I'll talk about the practical steps a little bit later. Traditional IRAs, there's a 10-year distribution period that came into effect with Secure 2.0. They finally clarified the rules on that. And Roth IRAs, we're not crazy about Roth IRAs for Australian beneficiaries because they're taxed exactly the same as traditional IRAs. So if someone has paid all the tax up front anyway, and then they have to pay tax a second time, then, excuse me, clearly that's a suboptimal outcome. Cash at the bank, we know that's foreign situs, so that's good. Receipt is tax-free, reporting is mandatory on a 3520 if over 100,000 US dollars. I have some clients down in Melbourne who are in this situation actually, and they're so loath to complete a 3520 just because of the additional cost that will add to their tax return that they distribute from the estate in amounts under $100,000 just because that's what they decide to do. They don't really need the cash here and now. So that's different strokes for different folks. Next, life insurance payouts. Generally treated as foreign situs. Why do I say generally? Because the cash value, if there's an investment component to the life insurance, that's not treated as foreign situs. It's also not included if the beneficiary is a non-resident alien because it's non-US situs, so it's outside of the US system. So I've mentioned this estate tax treaty that the US has with Australia. Let's take a look at that. That's actually what it looks like if you download it from the internet. It really does look like it was written in 1953, and they scanned the paper because it was done by a typewriter or a old-fashioned printer, and that's what it looks like. So as I mentioned, someone trying to sound clever says, ha ha ha, you think the Australians are treated differently. Non-resident aliens only have a 60,000 estate tax exemption for US situs assets. Well, that would be true, but if you have an estate tax convention with the US treaty, excuse me, with the US, then it doesn't quite work like that. So currently there's a $13.99 million bill, exemption, federal estate tax exemption rising to 15 million next year. And the way it works is like this. It's extended, the estate tax exemption is extended to Australians in proportion to how much of the deceased estate was US situs versus non-US situs. And I think I may as well have just been talking in ancient double Dutch. So I will provide an example right here. So you've got your Australian non-resident alien beneficiary. They inherit a $10 million US estate. Wonderful. Well, what we know, first of all, is there's not going to be any US federal estate tax. Why? Because you have to be above 13.99 million for that to even apply in the first place. So the portfolio is split between 5 million in US situs assets, doesn't really matter what it is, we don't care, and 5 million in non-US situs assets. So how does the estate tax exemption work on the US situs side? Well, remember, because the non-US situs assets, they're free of estate tax in the first place. So it wouldn't matter if it was $100 million or $1 billion in intangible non-US situs assets, it's free of that system altogether. So without the treaty, what would happen is our beneficiary here, despite receiving a $10 million inheritance, would be very displeased to have to pay, or for the estate to have to pay, because they don't pay it themselves, it's the estate, for the estate to be on the hook for about a $2 million bill. That's what would happen without the treaty. However, with the treaty, the way it works is the Australian resident claims a proportionate share of the full US estate tax exemption, so 13.99 million. We see that down here in step 2. So half of the estate is non-US situs, therefore they get a $6.995 million effective exemption. Remember, they only inherited $5 million in US situs assets, and thus, last time I checked, 6.995 is greater than 5. No need for any US estate tax. So It is a wonderful thing that Australia has with the US. I've mentioned this a few times. I'm just going to have a quick drink of water because I've said so much already here. State, estate, and inheritance taxes. I'll load the next page so you can get a look at which states are affected by this. Does your state have an estate or inheritance tax? And Gerald writes in, when you own ETFs that span companies in many countries, how do you define situs? Well, Gerald, that's a great question. And I hope things are going well for you in Northern California. Um, it's pretty rare, not unheard of, but it is pretty rare for an ETF to own ADRs or truly foreign listed securities within it. Um, if you had your quote unquote international mutual fund or an international ETF, might it hold exclusively foreign stocks? I'd say probably yes. But if you did have some quote unquote world fund, that's the Morningstar category that undifferentiates between US holdings and international holdings. If you had a world fund, then there's every chance that you would, in fact, have the scenario you're describing. I think that's a great conversation point between you and the estate planner, but it's the kind of thing also where unless there's, nine or 10 digits after that holding, the administrative expense of splitting, because this is what would be involved, is literally looking at the composition of what that fund held, what percentage were US companies versus foreign companies, and then doing a split attribution of some amount of this fund is US side or some amount is not, is how you'd ultimately do it. Is someone going to bother doing that for anything less than 10 million or something like that? I really don't think so, because it doesn't matter anyway, right? With the estate tax limits being as high as they are. Okay. So as I mentioned earlier, state estate taxes. Washington and Oregon are onto you there. So you thought you were getting away with state taxes in Washington, but not so fast. What will they hit you with? An estate tax is going to be pretty low, down at nearly 2.2 million. But watch out for states such as Nebraska and New Jersey and Kentucky. Holy mackerel, $1,000 exemption inheritance tax in Kentucky. So that's one to really watch. This only matters with with real property situs in those states. Otherwise, and maybe if you're a tax resident of those states, that's another, for an inheritance tax, I mean, not an estate tax. For an inheritance tax, that's probably a thing too. I don't know that for sure, though. That's one to check with your tax counsel. If merely being in Kentucky and you receive an inheritance from someone in New York, might that result in you paying a Kentucky inheritance tax? I don't know. I would think so, but I don't know that for sure. Um, yes. Okay. Issues with non-resident beneficiaries of US trusts. So a little bit of a change of pace here. Uh, so when US domestic trusts have non-resident alien beneficiaries, multiple tax and compliance issues arise. It's really not that bad. I think it's probably overstated the the the, the downsides here, because they're easily managed. If you're working with appropriate counsel, then it's going to be taken care of. So the trust itself is responsible for withholding tax obligations. So it's got to withhold at an appropriate amount for a foreign beneficiary. Tax treaties can reduce that amount. For Australian beneficiaries, it's 15%. So where the trouble would arise is on the failure to withhold, because that's what the IRS fears more than anything else, is money has been created in the US that has not been taxed, that has leaked out to a foreign country, and they've got no way to claw that back. So that's why they're insistent on that withholding tax. And then documentation requirements, a bunch of different forms need to be filed, and the NRA receiving that US source income needs to file a 1040-NR. 1040-NR, what's that? That's the non-resident annual federal tax form. Jeff Melton writes in, Kentucky completely exempts inheritors who are spouses, children, grandchildren, and siblings. That's interesting. So if If it's just a well-wishing random person, then watch out. Then Kentucky will be on to you. So that's a random one. I did not know that. Thank you, Jeff, for that point. Strategic estate planning for Australian beneficiaries of US estates. This is part of what you came for. The next topic is also what I think you came for, the practical differences. So what do we have here other than slides not appearing or bullet points not appearing in the order that I had hoped they would? Estate tax consequences apply to the estate itself and rarely ever to the beneficiary. So if you are that Australian receiving the proceeds of a US estate, the IRS isn't going to send you a bill. The estate itself is taxed. So you don't need to worry too much about that. Tax efficient estate planning is really important because the goal after all of this is to maximize the transfer of the value that goes to the next generation. There's no awards. There's no point whatsoever leaving a tip for the IRS, the ATO, as you heard me say before. Tax efficient estate planning for US estates will involve focusing on bequesting non-US situs assets to your foreign beneficiaries because they're not considered as part of the taxable estate in the first place. Now, does that really matter if your estate is below the estate tax threshold? Probably not. It really wouldn't matter. However, it might matter. Let's back up a few slides here. It might matter in these states. So if you're in an estate that has a state estate tax, try saying that 10 times fast, a state estate tax, then this could be an issue where you would be wise to make your beneficiaries of non-US situs assets your NRA folks. So if I mean it's going to be a rare circumstance, but no doubt someone on today's call does have that situation. Okay. Is it possible? Now, this is the kicker here. And remember, I do these webinars for education, but some of the gems we also hold closer to our chest. And this is one of them. I'm going to phrase it as a rhetorical question. Is it possible to turn a US situs asset into a non-US situs asset? How might you do that? Is this old-fashioned alchemy? Well, kind of is, actually. So what if you took a US tangible asset and you put it into a US situs asset and put it into a non-US situs wrapper? For instance, private placement life insurance. Magically, you've taken those US stocks, put it into a life insurance wrapper, and suddenly it's no longer US situs anymore. Could you do this with real estate and maybe hold the real estate in an LLC or some other entity that's not considered to be US situs? Maybe. Hey, I'm not going to go into that here today. But one thing you should know about this is the US estate holder is a qualified domestic trust, and that's very important when you have a situation with a US citizen married to a permanent resident, aka green card holder. Remember what I said before, the US fears nothing more than money that's been created in the US escaping the US and not being taxed. And so that's why these QDOTs exist. It allows a permanent resident who could otherwise say, well, now that my spouse has died, I'm going to get me out of here and go back to whatever country I came from. And I'm going to take all those millions that I inherited with me as well. And I'm going to say goodbye to the US. Not so fast. The US is onto that trick. And so they have this thing called a QDOT, and it allows you basically to get the full domestic exemption that would otherwise not apply to the permanent resident spouse. Okay, and here's a summary by asset class, as I said before, as how different assets are situs, whether they be US or not, whether a state tax would apply. Of course, the $60,000 value doesn't apply given the US-Australia estate tax treaty. And then we've got the Australian tax treatment over here, if there's a step up in basis provided or not. As I mentioned, it's actually pretty straightforward, this kind of planning for the avoidance of a state tax on the non-resident alien beneficiary, provided they don't receive US situs assets. There's a step up in basis. If they're below the limits, then there isn't any federal estate tax to worry about. All right, stories from the trenches. I'm just going to see how we're doing on time here. 15 minutes. We'll probably need all 15 minutes. If you've got your questions, you'd be wise to begin thinking about those when we get to the Q&A. But stories from the trenches. This is the thing. What I've gone through here is how an estate should be processed in theory. In practice, it is a very, very different process. Let me talk about some of the things that an Australian non-resident alien beneficiary is going to come up against. Firstly, receiving that beneficiary without a social security number. You need to go get an ITIN. That in itself can be a project, very difficult to obtain. Social security numbers don't expire. That's another question that comes up from time to time. They will last forever. So even if you were in the US 20 years ago, your social security number will still be valid. Now, starting in 2008, because of some of the shady shenanigans that a certain Swiss bank that's now the major Swiss bank still in existence was up to, the US has really cracked down on know your customer and anti-money laundering compliance. So they introduced following 2008 FATCA rules, and this is a very complicated and expensive process for US financial institutions to comply with. So what do? They, in their KYC, they CYA. I've never said that before. That's not a bad saying right there. In their know your customer compliance, they are trying to cover their backsides. And the way they do it is they are very strict about what specific identity they're happy with. Andrew's written a question, but because I'm on a roll here running through the real world issues, I'm just going to keep going and address that in the Q&A. Forced retirement account liquidations, that would be very, very bad news indeed. That would mean someone sitting on $1 million 401k, non-resident alien receives it. For whatever reason, they can't open an inherited IRA to roll that over to, then the 401k custodian, or if they distribute that check, they sent you a check, that would be financial harakiri. And the reason why is because that's going to be taxed through the progressive scale to the full value of that account. So that would be very bad news indeed. This is typically why we would counsel periodic distributions to manage that marginal tax rate, to keep that marginal tax rate down as low as you can. FATCA compliance, this is a rule that's been around since the 70s. No one paid any attention to it for 40 years, actually, until the 2010s, when suddenly interest peaked up following 2008. So it's foreign account compliance rules. You do need to file your FBARs, et cetera, et cetera. So what do many US banks do? They are not interested in this additional compliance work. So they just say, thank you, but no thank you. You've got 30 days, go take your business elsewhere. Not very nice. Foreign exchange and transfer costs. This is another one. You can run into trouble with AUSTRAC reporting, transfer limits, daily limits, moving money from a bank account to an investment account. Even getting that bank account opened in the first place can be next to impossible for a non-resident alien. So the practical difficulties of how you handle such an inheritance can be substantial. Next, limited cross-border expertise. There aren't that many, as most, if not all of you on today's call would know, there are few US/Australia estate attorneys. I only know of two. And CPAs, there are very few there as well. There's more than two, but there's not that many more that really have this deep experience. This is a very much a self-serving set of lists of issues that I'm mentioning here, because this is exactly what we do to help clients. But it's real world. It's true. What I'm saying is 100% factual here. Estate delays. You can be dealing with multiple jurisdictions. That's becomes an added problem if someone is using a Washington Convention will. What's a Washington Convention will? A Washington Convention will was a UN resolution where a number of countries that signed this quote unquote Washington Convention said that if you have a will prepared in a certain format, then it will be honored in multiple countries. The problem, however, is what happens when you need serial probate granted. So probate cannot even begin to be determined in the second country until the first country is done. And in the US, depends on the state, of course, but you could be looking at months or years for probate to be determined, and then the next country can get involved. So it can be a morass. Dual filing requirements now suddenly non-resident beneficiaries need to file US taxes to report certain income. There's withholding issues as well. Withholding tax recovery. This is another issue that's really come to the fore in the past couple of years. So even the custodians that we use that are happy with Australian residents, they sadly will withhold a full 30%. It's as if the income tax treaty between Australia and the US didn't exist at all. They just say, we're not in the business of determining these withholding amounts. You take that up with the IRS because we have everything to lose and nothing to gain if we make an error here in this withholding. So we're just going to withhold 30%, and then next April 15th, you send your 1040 NR off to the IRS and they will refund you or not. Online platform restrictions is geo-blocking and other difficulties like getting a two-factor authentication code, calling during business hours. So really what can you do is plan ahead, establishing proper documentation and professional relationships before this inheritance occurs. No reason you couldn't file for an ITIN before an inheritance occurs. You can expect delays. You can expect this is going to be very difficult to administer. And I even heard it from a lady, Paula Jones is her name, based out of Philadelphia. She's an international estate lawyer, doesn't claim to specialize in any particular country. She's more of a generalist, but she was the one that told me that it's not unheard of for custodians to be, you need to sue them, to compel them to make a distribution, because without being compelled, they're so afraid of doing the wrong thing. They don't know what the right thing is. They only deal with Americans in 99.9% of cases. And so in some rare instances, to even get a distribution, it's necessary to threaten them with a lawsuit, because you're just saying you need to follow the rules. You just need to distribute this darn account, and not every beneficiary is going to be American necessarily. Budget for costs and consider alternatives. Hopefully you have an estate owner in the US who's mindful of these complexities and is planning ahead. Sydney, where do dual citizens fit on your upfront matrix? And where should we be leaving any US assets? And should we be leaving any US assets to dual citizen children rather than the Aussie spouse, especially since spouse does not have a green card, Social Security, or ITIN? Oh, wow. Sydney, what a tough one. Let's look at that again. Where do dual citizens fit on your upfront matrix? And where are you resident? That's the first question. Because estate taxes have to do with what's called domicile, the domicile definition of residency. So I'm going to assume you are in Australia. We're living in Australia currently. Okay, yep, a good assumption. So where do dual citizens fit on your upfront matrix? And should we be leaving any US assets to dual citizen children rather than the Aussie spouse? This gets complicated by another factor, and that is, what is your residency intentions? If you intend on staying in Australia from here on out, something that comes up, I never recommend this. This is an entirely personal and subjective decision, but some folks consider whether all of the tax restrictions and complications and filings that are necessary for US tax residents abroad, if they have the stomach to handle a lifetime of that, they may consider relinquishing their US citizenship. There is a bill being floated, or not, a bill being proposed or pushed by the Democrats abroad. It actually has bipartisan support because it was originally proposed last year by Republicans. And that's to do with eliminating what's called the citizenship-based taxation system of the US. So it would go a long way to dealing with some of the inequities that Americans abroad face. But going back to your question here, the reason I raise that is because if you relinquish your US citizenship and you're deemed what's called a covered expatriate, then there's a sleeper provision in that rule that affects the US citizen children of covered expats, where they get hit with a 40% inheritance tax should you expatriate and be a covered expat. However, there's planning that can be done to avoid being a covered expat in the first place. So where do dual citizens fit on your upfront matrix, and should we be leaving any US assets dual citizen? I actually concluded this presentation by saying mostly it's not a problematic thing for an Australian to inherit US assets if you're below the federal estate tax exemption and if you don't have assets in US states that have state estate taxes. So I don't think it's such an issue because I think that's a presupposition of your question is that it's a problem, it's something to be avoided, but I really don't think it is. Uh, yeah, get it. He might be interested in applying. This is unrelated, but something you'll be very, very glad to know about is if you yourself have qualified with Social Security, which is done by obtaining 40 quarters of coverage of paying Social Security in the US. Obviously, I don't know you. I don't know how long you lived in the US, or if well, presumably you're a US citizen because you're a dual citizen. If you vested in Social Security, then your partner, even though he is a US NRA, is eligible to receive a spousal Social Security benefit. So that being the case, that would mean he's eligible to obtain a Social Security number, in which case that would really grease the skids in handling the estate when you eventually pass away. I think that's a wrap, folks. I've been finished for a couple minutes here. There's been no additional questions that have come in. Thank you very much. The only ask I have of you, the only ask I have is if you know someone who may be interested in these topics, then please invite them along. It's good to just get the word out there and have a more informed population about these issues so that people can make better decisions. Be well, and hopefully I will be speaking with you next month. Have a good rest of your morning, evening, or whatever the case may be. Thank you. Bye-bye.